And today we welcome Tey Tze Ming. He's a strategist at trading and brokerage firm Saxo Capital Markets. And his pick from his last interview, Neptune Orient Lines, is now the #1 performing stock on Singapore's benchmarking index this year. Ming, so good to have you with us here. So let's talk about the recovery, because you are a big believer. Interesting, because some people think that it's fragile at best. So what are you seeing supporting your view?
Hi, Susan. Well, we do think it is fragile, but over at Saxo, our view is that we are way past in an economic recovery, and that we are firmly on an expansionary phase. So if you look at the equity market from this perspective, you want to be picking stocks now that will benefit medium to late within this cycle.
Okay, well, other equity managers, let me just name them for you. That's Aberdeen Asset. They prefer to be in defensive stocks, such as telecoms, because they are sheltered from possible shocks that may actually derail the recovery, especially what we're seeing in Europe with the Greece debt default risk, etc.
Well, that's true. I mean, defensive stocks do have a position in your portfolio. You have to be positioned. But I think Greece, that's been hogging the headlines recently. It's a lot of noise at this point, and they have announced a decent plan to turn around. We're looking forward to their some cutting measures that they're going to announce later today. And if you look at the world economy on a broad basis, I think the economic recovery that we are seeing is actually sustainable and here to stay. If you look at ISM manufacturing numbers, for example, that we saw at the start of this week, they were slightly lower than expected. But if you look at the hard numbers, they are actually above average levels that we've seen in 2006 and 2007. So, manufacturing is going to be contributing to this economy, and we think this recovery is solid.
Okay, well, if you're blowing off the risk coming from Greece and the Eurozone, what about people who talk about a bubble in China? For instance, we have a hedge fund manager, famed hedge fund manager Jim Chanos, coming out and saying that there might be some high risk in China. Then we have Ken Rogoff from Harvard, of course, saying that there's a potential bubble brewing as well. And then we have Northwestern University professor Victor Scher weighing in, saying that China's hidden borrowing may actually push government debt to 96% of GDP next year. What do you think of these risks and these warnings?
Well, Susan, I completely agree. I think if you look at the property market in China, for example, it does smack of a bubble that's being built, especially when you take into account factors like affordability and the rapid price increases that we have seen in recent months. But the problem with bubbles is that the conditions that are supporting these price increases that we're seeing right now, the cheaper money that's set to maintain for some time to come, and some of the underlying economic conditions, it's very it's very difficult to predict, right? And I'm not even going to hazard a forecast when this bubble could pop. And the reality of it is that.
In the meantime, then, if you're waiting for this bubble to pop, but what's the strategy?
I think it's only considered a bubble if you're not invested. I think these economic conditions will stay supported for quite some time to come. The problem is that China is, after all, still going to grow at around 11% this year. That's our expectations. And it's a super red hot economy, and heating up of the property market is just one buy condition or symptom, if you like.
Okay, so would you buy into China then, Ming? I mean, what markets are you putting money into or advising clients to put money into?
Well, one of our picks for Singapore is CapitaLand as well, and they are pretty heavily invested in China property at this point. We still think that's a decent call. We can talk more about that later.
Okay, well, no, let's talk about CapitaLand. That's right. It's actually among your top picks in Singapore. Let's first talk about the REIT, though, Capital Mall Trust and CapitaLand. Why do you like these particular stocks? Is it about its exposure on the mainland, or is it about its property elsewhere?
Well, if you look at Capital Mall Trust, their portfolio is very broadly diversified across Singapore. I think if you look at the Singapore property market, for example, I think in recent months the trend has been that the price increases have not been flowing to premium downtown areas, but rather it's on a broad base mass market kind of move. And I think Capital Mall Trust portfolios, they're very well positioned to capture this price increase once it filters down to commercial properties in this state.
Okay, well, these, I guess these two companies are quite diversified. They have China exposure, as you mentioned. Also, Australia contributes about 25% to CapitaLand sales last year. But of course,
that's right.
You know, we had the interest rate increase yesterday in Australia. Also, you see China tightening lending at this point. So what about tightening credit conditions? Does that pose a risk to CapitaLand?
It does to some, you know, little factor, but we don't think that's going to pose much of a problem for CapitaLand. In fact, I think the RBA tightening 25 basis points, for example, is a very good sign that the property market has stabilized and that there is further room to grow.
Mm-hmm. Okay, and as I see, your well, the analyst average target price is for 435 Sing for the stock. Do you agree with that outlook, or could it actually even overshoot that point?
Which one's this for?
We're talking to Capital Mall, not the REITs, but the Capital Mall, the actual land bank itself. Yeah.
Well, we share that. I think our price target's for about 35% upside from here, so there's still definitely upside.
Wow, 35%. So that's some pretty healthy gains. Okay, so let's quickly talk about the REIT. Yeah, Ming, let's talk about Capital Mall Trust because it is trading on a higher valuation among Asian REITs. Why does it deserve that premium?
Well, I think CapitaLand properties on average, they are slightly better managed in our opinion. And if you look across the range of commercial REITs, Capital Mall Asia, for example, is trading at even higher valuations. So I don't think you know it's that much of a premium for Capital Mall Trust.